how much are you looking right now, Howard, for looking at a buying opportunity of some sort of ceiling in yields that we already surpassed with the confirmation from the Fed this week?
Well, Lisa, it certainly has been very painful. The pendulum has swung from full greed to, I think, pretty full fear. And that's the good time generally to be buying stocks when they're down. You got the S&P down over 20%, the NASDAQ down over 30%, a lot of stocks down 40, 50, 60, even 70%. And so I have to believe that unless you think interest rates are going materially higher, this is a good entry point for stocks. And I would note that we think that the reset to multiples from higher interest rates is probably mostly baked in at this point. And I think it's important to realize that after the Fed raised rates this week, which I think reinforced some credibility, which they've been missing in terms of inflation fighting, after they did that, the 10-year bond yield declined. It's about 20 basis points lower than it was earlier this week, as Jonathan just said. So we've had the reset on multiples from the higher rates. The rates more than doubling so far this year. But the next thing has been the reset on the concern about a cut to earnings. And certainly some companies' earnings estimates are too high. Some companies will have lower earnings. But I think in the aggregate, earnings will continue to grow, maybe not at a 10% rate this year, but I think they'll grow. And I think most of my growth stocks will have higher earnings. So in that context, yes, I think this is an excellent time for investors to take advantage of the carnage. It's widespread, it's deep. And I don't think we're going to have, if we have a recession, I don't think it's going to be a deep and long one. I think it's going to be relatively short because the job market is just too strong.